Hey there, fellow investors. Let's talk about making those dollars work hard for you. You wouldn't buy a car without checking its engine, right? Same goes for stocks. You gotta look under the hood. That's where profitability ratios come in. They tell you how good a company is at turning sales into actual profit. Think of it like this: you bake and sell cookies. The money from selling those cookies is your revenue. Profitability ratios tell you how much money you actually get to keep after buying flour, sugar, and paying the oven guy. There are a bunch of these ratios, but we'll focus on the big dogs. We're gonna break them down in plain English so you don't need a PhD in finance to understand them. First up, the mighty net profit margin. Net profit margin is like the MVP of profitability ratios. It tells you how much profit a company makes for every dollar of sales it generates. Higher the margin, the better. Think of two lemonade stands. Both sell a glass for $2. One stand spends 50 cents on lemons and sugar per glass, the other spends $1. They both make money, but the first stand keeps more of each dollar earned. That's higher net profit margin in action. Now let's bring this home with a real-world example. Imagine you're looking at two tech companies, Techie Titans and Gadget Gurus. Techie Titans boasts a net profit margin of 20%, Gadget Gurus lags behind at 10%. What does this tell us? For every $100 of revenue, Techie Titans keeps $20 in profit, while Gadget Gurus only keeps 10. Techie Titans might be better at controlling costs or pricing its products higher. Either way, it's a good sign for investors. But remember, a single ratio doesn't tell the whole story. It's like judging a book by its cover. We need to dig deeper. Now, let's talk about those times when companies aren't exactly rolling in profits. Maybe they're just starting out or facing tough times in the market. That's where operating profit margin comes in handy. It tells you how much profit a company makes from its core operations before paying things like interest and taxes. Think of it like this: it shows you how well a company is managing the costs directly related to making its products or services. Let's say our lemonade stand is losing money because we took out a big loan to buy a fancy new juicer. Ouch! But if we look at our operating profit margin, we can see that we're actually doing a good job of controlling the cost of lemons and sugar. This means that once we pay off that loan, we're in a good position to start raking in the big bucks. Operating profit margin helps us see the potential for profitability, even when a company is facing temporary setbacks. It's a valuable tool for investors who are willing to look beyond the headlines. Section 4. Demystifying depreciation, a non-cash expense. Before we move on to the next big ratio, let's talk about something called depreciation. Now, this might sound about as exciting as watching paint dry, but trust me, it's important. In simple terms, depreciation is like accounting for wear and tear. Remember that fancy new juicer we bought for our lemonade stand? Well, over time, it's going to get old and rusty. Depreciation is how we account for that decline in value over the life of the juicer. Here's the thing. Depreciation is what we call a non-cash expense. We're not actually writing a check for it every year. Instead, it's a way of spreading out the cost of that juicer over its useful life. This is important because it impacts a company's profitability ratios. A company with a lot of assets, like factories and equipment, will have higher depreciation expenses. This can make its net profit margin look lower, even if it's actually doing well. Section 5. Return on equity, or ROE, gauging a company's efficiency. Now let's talk about return on equity, or ROE for short. This ratio is all about efficiency. It tells you how much profit a company generates for every dollar of shareholder equity. Think of shareholder equity as the company's net worth. It's what's left over after you subtract all its liabilities, debts, from its assets, things it owns. A high ROE means a company is using its money wisely to generate profits. It's like a superstar employee who consistently delivers outstanding results. Let's say you invest $100 in a company. If that company has an ROE of 10%, it means it generated $10 in profit for your $100 investment. Not too shabby. But what's considered a good ROE? Well, it depends. Different industries have different benchmarks. A tech company might have a higher ROE than a utility company, for example. It's important to compare apples to apples. Section 6. Bridging the gap from ROE to investor returns. Now here's the thing about ROE, it's important, but it doesn't tell the whole story about investor returns. Why? Because companies can do different things with their profits. They can reinvest them back into the business to fuel growth, or they can return them to shareholders in the form of dividends or share buybacks. Dividend policies can have a big impact on investor returns. Some companies pay out a large portion of their profits as dividends. Others prefer to reinvest most of their earnings. There's no right or wrong answer here. It all depends on your investment goals and risk tolerance. So, there you have it. A crash course on profitability ratios. Remember, these ratios are just tools. They don't predict the future, but they can help you make more informed investment decisions. Keep learning, keep asking questions, and as always, may the market be with you.